Welcome to Scope's Portfolio Manager Conference. My name is Manqing Sun, mutual fund analyst from Scope Analysis. For this session, I'm very pleased to be joined by our guest speaker, Kiran Nandra-Koehrer, Senior Client Portfolio Manager, Head of Emerging Markets Equities Management at Pictet Asset Management. She's joining us on the line today from London. Welcome, Kiran.
Hi, Manqing. Thank you very much for having me today.
So our discussion today will tap into Asian equities, which have made a lot of headlines this year for many reasons. Together with Kiran today, we will take a look at the bumpy trajectory of growth upcycle in Asia so far this year and what's on the horizon for Asia equities in 2022. During the session, we'll cover a wide range of questions that's been on investors' mind recently about, for example, the policy tightening, the economic growth prospects, inflation, supply chain constraint, as well as earning and valuation and Asia's IPO market. I'm also going to ask Kiran to share her take on the impact of US-China relationship going forward and what to expect from China and India's recent climate pledge. Before we begin, I'd like to remind you with few logistics of webinar replay will be made shortly after the live event. You could watch the clip on our website anytime you want. And also, we'd love getting your questions, so keep them coming throughout. We'll do our best to answer as many as we can. So let's go ahead and jump right in. First, Kiran, please share a few words about yourself. What is your role in Pictet and your background relevant to this asset class?
Sure. Thank you, Manqing. So I joined Pictet around 6 years ago, and always as part of the emerging equities team at the firm. Prior to that, I was at Wellington Management for 12 years. I've always been involved in equities, always had a very, very strong, active, fundamental belief in investing, which I think actually is very relevant for emerging equities, where there's a very high degree of idiosyncratic risk, as we know. And the team at Pictet has been investing in emerging markets for, 30 years now. So it's definitely an asset class that we are very, very familiar with and very, very comfortable with.
Mm-hmm. So to your point, we know that Pictet has quite long history in Asia and is now building out in the China market with a new office in Shanghai. So let's begin with some high-level context over the general market in China. Could you start off by giving us a bit of overview about the state of Chinese economy situation right now, and as year-end is approaching, what can we expect in the coming fourth quarter?
Yeah. So I think just turning here. So I think definitely, China has had a bit of an annus horribilis this year. We've had the regulatory reset followed by jitters across the real estate market. And I think it's probably led to a bit of a reassessment by international investors as to what it actually means to hold Chinese equities, especially when we look at what happened with the education sector, for example. But here I think it's important, and we're going to talk about all these issues in more depth, but I think it's important to separate out what happened on the e-commerce and education sector with what's going on the property side. That's clear. That's been the kind of front and center in terms of headlines, economic impact. So I'm just going to focus on that here right now. So the property sector is around 25% of GDP, but importantly, it's important to bear in mind that property actually has been slowing down for some time already. So it's certainly not the main driver of Chinese growth, as Chinese growth has been more driven by other sectors across services and consumer in particular for 7 years now. But on a more forward-looking basis, it's clear that what's going on with the property sector does have the potential to present a bit of a headwind for economic performance. But our base case is that actually the odds of a housing-driven financial crisis are low in China. And that's because the property market is in a multi-year slowdown, but policymakers are really recognizing that we have waning fundamental demand for housing in the coming decades. So they're really acting strongly now to deleverage the sector and actually stave off the risks of a disorderly correction further down the road. But we think with all of that being said and done, we think it is inevitable that towards the end of this year and start of early next year, you do have the kind of slightly tailing off of GDP growth. And so because of that, we would actually expect the government to ease some of the fiscal and monetary policies just to try and support growth, to act as a kind of bolstering of growth, and in particular, prevent a property-led hard landing. So basically, I think that the mood music here is that the property sector is in a bit of a kind of multi-year slowdown, but we'd expect property policies, financial regulations to become less hawkish as a result. And I would say generally we're encouraged by the fact that when the whole Evergrande issue first came out, remember there were a lot of headlines around does this mean some sort of systemic event for China? And in our view is that it absolutely does not herald that at all.
Yeah, so maybe that brings us to current events. If we look at some of the data coming out of from China, whether the PMI, the GDP growth rate, one of the message we are getting while digesting these economic indicators, in particular of third quarter, is that Beijing is now willing to sacrifice some of the economic growth for its targeted structural change. So instead of purely chasing the pace of growth, they shifted their targets to multiple aspects: social, financial stability, common prosperity, housing price, decarbonization, with aging population slowing down growth rate in mind. That said, could you help us to frame some of the key headwinds and tailwinds for China's economy prospects in 2022? So if deceleration are largely policy-induced, will we see a policy-induced recovery next year? What could be the biggest variables there, and what opportunities and challenges do you see there?
Yeah. So I'm just going to take us over maybe to then just give a bit of context. I mean, I think those that kind of hit the nail on the head there. So I think part of the sacrifice, as you mentioned, is really to do with the policy of common prosperity. And it's really the country getting to grips with an aging population. So China's demographic profile is changing in a way that isn't necessarily in China's favor in terms of that, that kind of, we think about emerging markets and we think about, demographic dividend. We'll talk about India later on, but, China is really on the opposite end of that trend. So basically the country needs to do something to improve productivity across the entire economy. But in addition to that, they're trying to create a more balanced form of wealth creation and wealth distribution. And so we spoke about the real estate side, and turning around that real estate sector is clearly a big part of that as they try to shift the economy into more productive sectors. And to your point, so where could we actually find some of those more productive sectors? So where do we see those opportunities? And I think we've had a bit of a step change because we've had the 5-year plan that came out towards the end of last year, and you've got much more of this kind of top-down realignment of which sectors could actually be interesting to invest in, and frankly, which sectors should possibly be avoided if you're looking for kind of growth and expansion opportunities. So with all of that being said, I think we see we see 5 very clear areas of growth and traction for the country. I've highlighted some of these here on the slides, but I would say much of what happened this year can be seen through the lens of the 5-year plan. And so the first thing that I think is key will be this push for what the country calls self-dependent innovation. And I think that clearly is a preference for national champions, especially in areas that are linked to technology and artificial intelligence. Secondly, it's a focus on domestic demand expansion. And we interpret that as really being a push for supporting household consumption. That's clearly linked very much into the idea of common prosperity and the sharing of wealth across all classes in society. Tangibly, what that means is rather than the conspicuous and somewhat luxury consumption that has really been the calling card or the perception of Chinese consumption, we would expect some of those more kind of attainable but yet still aspirational goods to be in favor. So maybe, as I say, shifting away from that kind of high-end super luxury to that more attainable form of kind of goods and services that the majority of the population will be looking for.
Yeah.
Thirdly, in terms of just maybe the high-level opening up, it's really the desire for Chinese capital markets to be the market of choice for international investors. So this should benefit companies, financial companies such as insurance, asset management, but also stock exchanges, especially as the country starts to modernize its financial sector. Then we have a bit of a focus on environmental standards. So the country's made its net zero ambitions very clear. And so we're actually anticipating and already seeing an increase in things like renewables and electric vehicles. And then very finally, on the fifth thing is a focus on the real economy. That kind of speaks to infrastructure. And it's not just the old kind of bricks and mortar type of infrastructure, but it also encompasses tech infrastructure. And so what this tangibly means is that it's possible that we see a shift away from consumer internet and into industrial internet, right? So it's including things like data centers and just having more of a kind of infrastructure highways, if you like. So I think those are kind of 5 very, very key areas that we would see as being actually pulling in investment and growth opportunities.
I think you covered a lot of sectors there, and I'm sure we will dive deeper into these opportunities in the later part. But first, let's talk about the impact of the recent power shortage. Are there concerns over the corporate earnings prospects given the suspension of production in some regions due to these power shortage? Is it a good buying opportunity considering the valuation might be supportive in this regard? Have we seen the worst of the sell-offs yet?
Yeah, so maybe just starting off with the whole energy, the energy side. So it's true, as at the end of last quarter, we did see a number of energy shortages starting to emerge. Now, this wasn't just clearly linked to China or EM. It's something that we've seen obviously a lot in Europe. The issue for China is that a lot of provinces actually started to shut down production in order to meet some of those kind of energy intensity targets, but also kind of consumption targets. So, that whole idea of dual control. And that's, pretty much been linked into the emergence of coal and electricity shortages. Since then, though, we have seen that policymakers have put in place a number of measures to try and alleviate that. And so we have seen